Hello, this is Angus Murray from Castlestone Management. I just wanted to present to you 10 slides, particularly highlighting slide number 8 with regard to what happens to equities once the US has entered into a recession. And the US entering into a recession was confirmed by the second quarter of negative GDP growth yesterday. Therefore, three main points we'd highlight. First of all, that the US economy is in a recession as defined by 2 consecutive quarters of negative GDP growth. Second point is that equities actually performed the worst 1 year before a recession, which you could say has certainly happened in the last 7 months. And although recovery times and strength vary, equities tend to have a positive performance once a recession has started, meaning somewhere around the point we are at the moment. And the third point is that there is clearly an expectation coming through that the Federal Reserve will be lowering interest rates into calendar 2023 once it has controlled inflation. And that's given in a chart in this presentation about the implied 3-year T-bills 18 months out. Looking at the second quarter GDP numbers which came in yesterday, another decline, and therefore technically the US is in recession. One point to highlight is that could be revised in the coming months, but there's clearly a significant slowdown in the US economy. Federal funds rate is the cause of that. As we've seen, the US Federal Reserve increased interest rates by 75 basis points this month. So the implied federal funds target rate is now between 2.25% and 2.5%. And that is having an effect on the economy, which will pass on to slowing down inflation. But you can see that the consumer is still quite strong, although there is clearly a drop-off in the strength of consumer spending. And of course, that is leading to the slowdown with regard to the US economy. Then, if we take a look at what is happening with regard to expectations 18 months out from now, there is very clearly a change in expectation that rates will be beginning to come down in calendar 2023. If we take a look at the 10-year bond on an historic basis, it's returning back to a more normal level post the enormous amount of debt that was created in the global financial crisis, but the 10-year bond is now yielding a little under 2.7%. The most important slide, though, is this one. If you could just take a look at that green box, and although it's perhaps not so clear when we send this in WhatsApp, it is implying or looking at what happens in the 6-month period after a recession has started. So first of all, stocks perform worst 1 year before a recession. So in this case, it's been the last 7 months. And then this is looking at what happens after a recession has started, which technically it did yesterday. Therefore, looking at 6 months after a recession has started, on average, or at least 82% of the time, the equity market is up by 7%. If we look at what happens over the next 12 months after a recession started, i.e. 12 months from now, in 91% of the cases, the equity market is up 16% on average. And then going out 2 years, in 82% of the cases, the equity market is up 20%. I think, therefore, there is a very clear sign, although we can't be sure that the equity markets have bottomed, there is a clear tendency from looking at the way equities react historically that we have seen a bottom in the market, and we will now begin to get, although perhaps slowly, a more positive performance from the US equity market. Slide 9 is just looking at those numbers in a slightly different way. This is the performance of $10,000 after a recession has begun. And you can see that when you look out 24 months after a recession began, equities can be up anywhere between 20 and 60%. And then lastly, just taking a look at the data again in a slide which we presented to you before, after the S&P has fallen by 20%, which the S&P has fallen by more than 20% since the beginning of the year, although it is now slightly above that number. Data going back to 1950 shows that 3 years later, equities on average are up 29%, at least 89% of the time. In other words, a positive outlook with regard to 6 months, 1 year, 2 year, and 3 years. And that is particularly highlighted on slide 8. If you need anything further, by all means, please let us know, and we'd be happy to answer questions where possible. Thank you.